Hello, welcome to this video on regression-based budgeting using Microsoft Excel. I'm Carlton Collins, and let's get started. The essence of the article in the Journal of Accountancy on regression-based budgeting is to teach one primary concept, which is this. If you export multiple years of historical data, as I've done here on screen, columns B, C, D, and E are all historical income statements out of QuickBooks. I can project my budget for the next year simply by dragging the fill handle, which is shown in the upper right-hand corner, to the right one column. And there's my 2018 budget right there. You can close the video, you can stop reading the article now because that's basically all I wanted to show you in this video. The remainder of this video is an attempt to explain why this works and why you can rely upon it. So the next thing I'm going to go to is I'm going to talk about this a little bit further, and I'm going to use a Excel-based trend line to try to visually show you what's going on. So here again, we have 4 columns of historical data. I can drag that out to the right, and I can get 3 more columns of projected data. And just so that we can differentiate that, I'll make that a different color. Now what's going on here, if I highlight these historical data and choose to insert a scatter chart, and let's just position that scatter chart and resize it under our data a little bit better. Let me stretch it out just a little more. What we've done right here is we have plotted these 4 numbers on a scatter chart. Now if we right click on one of those numbers and choose Add Trend Line, then we'll see a straight line is actually drawn between those numbers that dissect those numbers. And that trend line can then be extended to produce these other amounts. Let me demonstrate that to you. I'm going to insert a line as if we're extending that out a little bit. And to make that more readable, well, my line doesn't want to exist outside. Let me try that again. Insert shape. This time we'll make our trend line outside the chart. Then I can place it on top of it and rework it. Let me make that trend line a little different color so it stands out. And there you go. So the idea is if we continue these intervals along this dotted line path onto our imaginary path outside the chart, we will get these red numbers. And let's just try. Let's see what happens right here. I'm going to insert, I'm going to change my charts data, and I'm going to include these next 3 numbers that we just produced. And so now what we have, if I can put this back a little further, you can see what's happened is the first original 4 numbers, the historical numbers, are shown here. The path is extended, and then these 3 numbers all occur along this path. That's visually showing you exactly what happened when Excel used regression to calculate these values. These historical values were random, and they don't necessarily rely on the line, but these projected values all lie on the line at these same intervals. So here I'm suggesting it more visually with numbers. These are our historical values, our projected values, and then using the same color coding, these are our historical values and then our projected values along the line. And so that's what's happening visually. Let's do it a little differently. Let's take this same information and I'm going to use the older mathematical approach to calculating regression using slope. Now there is a function in Excel called slope, and we can highlight our known y values and our known x-axis values, and that gives us our slope. And then we have the and the slope is the well, we'll see it in the chart. Now let's do the intercept, equal intercept. And once again, we highlight our known y's and our known x's. And then there's the intercept amount, the point on the chart at which the theoretical line would cross the x-axis. Now, we simply add these together and multiply times the next period that we want to predict a value for. Let's make that a little wider so we can see it. And you can see it comes out to the exact same number, 1,176,995. Well, you just need to format it a little better so that it matches exactly. And so I'm proving to you here with mathematics that the line that is predicted whenever we drag the fill handle to the right gives you the same product as if you had calculated it using the slope and intercept formulas. Now, another way you can do it is there's a function called forecast, equal forecast. And here we put our next x, which is 5. That's the period that we want to predict. We highlight our known y's. We highlight our known x's. And that too gives us the same 1,176,995. And so that's yet another way to calculate with regression the next value in a series of numbers. So we've done it 3 different ways now. We've used the fill handle to predict this value. We've used the slope intercept to predict this value. And we've used the forecast function to predict this value. Right now, I'm not teaching you anything that's really that useful because the fill handle is so easy to use. Why would you not do that every time? But I am trying to explain to you there's mathematics going on beneath the surface so you can rely on the fill handle's numbers. So now that we've gotten that out of the way, let's jump into an example. And so for this example, I have gone into Microsoft Dynamics GP, which used to be called Great Plains, and I have extracted an income statement for the last 48 months for the sample company that comes with Dynamics GP. It's called Contoso Corporation. And so here's the income statement now. I'll scroll it to give you an idea of what we're looking at. I'll scroll back to give you an idea of what we're looking at. I know you can't read that anymore, but that is a lot of numbers going on right there. So now, for us to use regression to predict our budget, we have this 200 plus line item income statement. I'm going to highlight all 48 months. There we go. And I'm going to drag that out to the right 12 columns. And you can see that I've done that right here. And I'll let go. I'll highlight those 12 columns and give them a different color just so that we can see them. I want you to be able to see them. And now if I scroll in a little more, you will see, and it's hard to see the white at the top. Let's change that to a different color so you can see that a little bit better. But now here are the projected values for 2018. So I started with 48 columns. You can see the blue background and the blue subtotal colors. And now the yellow colors represent what we have projected out into the future. And so it's that easy. I did this with the QuickBooks example with years, but now I'm doing it with months to kind of show you how you would do it. Now, you might say, okay, well, there's my budget. I'm done. You're not done. At this point, there's plenty more work to be done, and I'm going to walk you through those. The article walks you through 8 steps, and this is just the first of those steps, was to export the data out to Excel. The second step was to drag these columns out. So we've only completed the first 2 steps. Next, we need to seasonalize our data. Now, the reason we need to seasonalize it, I can go back to this trend line and show you. You can see how the actual historical data do not run along the line, but the projected value runs right along the line. And that's not what really happens to our data. We have seasonality. Most companies have seasonality. A CPA firm, for example, will have a lot of income tax return fees and audit fees at the beginning of the year. But after March or April, those fees disappear, and traditionally May is a much lighter month. There's seasonality in the revenue, and the same thing happens with expenses. And so for us to pretend that we can just take historical data, which is seasonal, and project flat data, which is not seasonal, isn't enough. We've got to go a little further. So the next thing we're going to do is we're going to add these yellow columns together. I'm going to keep those yellow just so that you can see visually what's going on. But I'm going to put the word total 2018, and I'm going to total these together, equal the sum. And I'll highlight these yellow columns. I'll sum them together and double click to copy down. And now we have our totals. And just to format that a little bit, I'm going to highlight one of my previous columns, use the format painter, and we'll transfer that over. And because I did this in the article just to make it consistent, I'll make these subtotals red, or at least these ones at the top, just so you can match what I'm doing to the article. So now we've got our total, which is based on these yellow columns and based on regression. The next thing we want to do is distribute this red column, or these totals for 2018, to their 12 months with seasonality. And so to do this, I'm going to type in some dates, 1/31/2018, 2/28/2018. Let's drag that across until we get to December, and there we are. Let's make our column headings a little wider so that all fits in there nicely. And the formula, we're going to take this total for this first line item, $4,400,000, and we're going to divide it by 2017's total and multiply it by January 2017 right here. So equals our total divided by the sum, and let's scroll back to the total of 2017, and then multiplied times January 2017. And that gives us the seasonalized portion of that for January. Now, because we're going to multiply this and copy it down, I'm going to go in and I'm going to make my reference F4, F4, F4 to put the dollar signs in front of the column reference here. I'll do that again here, F4, 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 and this number I won't put any anchors in, but that's good. And then also I'm going to put a -2 at the end, go to the beginning, I'm going to put equal round, because these are budget numbers, we don't need pennies. I'm going to round that, format that, and now we're ready to copy this across and down. So we'll drag this across, we'll double click to copy it down, and we have just now seasonalized our data. You'll notice, for example, that sales amount, this for row 2 amount for January is $256,000, but for February it's $384,000, then it's $447 for March, then it goes down to $384 for April. So our data, our projections now, they're not straight, they're not flat. We didn't just divide by 12. We've now got a seasonalized budget that mimics the exact ratio of 2017's actuals, each month's line item to the total for that line item for the year. So we're basically following the same seasonality that was actually experienced in 2017 and now applied to this 2018 budget. Now to format this a little better, I'm going to come back over and grab the blue column, right mouse click, format painter. I'll slide over again, and there we go. Now we've formatted our seasonalized budgets for 2018. So that was the third step out of 8. The fourth step is we need to overwrite known values or projected values with our known values. And so in the article, I showed one example. Of course, there would be more than one. But in our case, what I'm going to do is I'm going to affix my freeze pane. I'm going to use the freeze pane tool. So I'll position my worksheet, put my cursor right here in the corner so that it is below the dates and it's to the right of the labels. I'll choose View, Freeze Panes. Now I can scroll my data and still see the labels. And that becomes a little more important for us at this juncture. We could have done that before, but now it really becomes a little bit more important. So now what we see is I can scroll down. The row that I used in the article was row 88, I believe. And it was, is that the one? I think it's row 213. Let's come down here. There it is. Rent expense accounting. Now, regression tells us that rent expense is going to be $73,320, and that's based on the last 4 years of historical data for this line item. However, rent, which is allocated to the various departments, is based on a lease agreement. So in this case, we have a lease contract which tells us exactly how much rent will be. And let's just assume we have renegotiated the lease agreement as of November in 2017, and we know exactly what the amount's going to be. So in this case, it's not going to be $73,320. It's going to be $88,000 for the accounting department. So we know this amount, and so we can plug that in. Now, once we've plugged that amount in, we ought to document it. And one of the ways that I'm going to document this is I'm going to use a color coding. Let's do this. And that is a clue to me that that amount is not a regression amount. In fact, because it's blue, I will know that's a contract amount. But to go a little further, I'm going to put in a review new comment, and I'll type in this amount is based upon the lease agreement signed on November 3rd, 2017. Now what we have is we have a comment. If I right mouse click here, I can tell it to show the comment, and then it won't disappear. And I can move it around so I can see the data that's underneath it. But now I have documentation for that line item. The last thing that I'll do is I'm going to change my formula because that's not going to be a seasonal amount. I'm going to just divide that number by 12, and I'm going to round it. Equal round. We'll take that number, divide it by 12, and then we'll round it to the nearest hundreds. I'll type in a little formula here and copy this across, dragging the fill handle. And there we go. So now what I've done, and I'll also put in the blue background too. Let's do that. Visually, that helps me understand that whole row is based on contract amounts, not based on regression. And so I would peruse my data. There might be 30 or so line items where I have a better number than regression. Maybe they're contracted amounts, and so I would overwrite the regression amounts with these contracted amounts. I would highlight them all as blue. I would then document them as I have done, and we would be off to our next step. So in the article, the next step is to test the data for regression suitability. Now this is probably a little bit out of order. You might actually test your data before you use your data. I realize that. But for the simplicity of the article and the flow of the article, I've put this step in there. As long as it's in here, I think it's good. But now what we're going to do is we're going to look at those other line items based on regression and just see if they even make sense. So I'll start by giving you a lesson on seasonality. So here is a series of data. It's not much data. It's simple data. And I'm gonna explain to you a function in Excel called the Pearson function. Now in this case, row 3 has the data 10, 20, 30, 40, 50, 60, 70, 80, 90, or 80. And we can calculate the Pearson score with equal Pearson and highlight the array, comma, highlight the axis data points, and I get 100% score. Now what that means is this is 100% reliable for regression purposes because there's an absolute trend to it. Now here in row 4, I've actually changed it slightly. I've changed 2 of the numbers. I've changed the 3rd position number to 55 and the 5th position number to 75. Let's calculate the Pearson score now. So we highlight once again our data, comma, our x-axis data, and we get a 90% score. So that's a pretty good score still. If you're looking at the Pearson score system, you can think of it as a college or high school test. If you got a 90, that's still an A. It's a low A, but it's an A. And so that's a good score. And likewise, that's a good Pearson score too. Once you start getting down into the D and F range for your scores and below F, that's when your data becomes less reliable. So this this 3rd set of data on row 5, I've really thrown in some random stuff here. 44, 18, 112, 33, 177. And let's calculate the Pearson now. We'll highlight the data, comma, we'll highlight the x-axis data, and we get a Pearson score of just 35%, which probably means this data doesn't have a good enough trend to it that you could ever rely on it for regression purposes. So in this case, we would throw this data out, or we wouldn't throw the data out, we would throw out the regression method for predicting the budget for this line item off historical amounts. So now that we've done that, let's get back over to our data. Let's show you how you would calculate the Pearson score. So I'm going to type the word Pearson, and on row 2, let's put it there. On row 2, I'm going to calculate the Pearson. Equals the Pearson for, and I'll have to scroll over past these yellow rows. I'm going to anchor here, and I'm going to scroll backwards. And I've got all 48 of those historical numbers for this line item highlighted, comma. Now I'm going to highlight the dates at the top. Whoops, got a little hyperscroll going on right there. There we go. And I'm going to put the F4 right there to anchor that with dollar signs. And there is our Pearson score. I'll turn that into a percentage. And that first row gets a very terrible Pearson score of a 33%. Now, I double-click to copy it down. I've got my Pearson scores all the way down now. But you'll notice that some of the Pearson scores are negative. And you might think, wow, that's really a bad score. Negative 97 is really a bad score. But that's actually not the case. Negative 97 means that it's a great score, 97%. And the data is trending downward, not upward. That's what the negative denotes. So if that's a little confusing to you, we can get rid of the negative sign simply by putting the phrase equal ABS in front of our formula and copying down. ABS is the absolute function. And of course, absolutes, they turn all negative numbers into positive numbers, and all positive numbers remain positive numbers. So now we've used absolute and Pearson together. And now that we've done this, I can highlight this data. Hold down the Shift key and down. I've highlighted everything now. And I'm going to use conditional formatting. The conditional formatting highlight cells rules, and we'll do the less than. And we'll put some data in here, Let's say 60%. Okay, let's say anything less than 60% doesn't meet our needs, and I'll click OK. So now, very visually, you can see the data that doesn't meet our needs with the Pearson ranking. All of these numbers that have a red would tell us that we need to toss out the regression numbers and we would need to use some other method for predicting those values. And in this particular case, if we scroll through, of course, we can ignore the subtotals because that's not really what we're working with. We could go through and erase all our subtotals if we wanted to, and erase the Pearson the conditional formatting colors as well, because they're not really meaningful. But in our case, we can leave them there too. But now what we're going to do is we're going to find a row that doesn't match the Pearson threshold. And in the article, I used row 191, I believe. This row right here only receives a Pearson of 33%. So what we're going to do is we're going to get rid of the regression numbers. We don't want those numbers at all. I'll just delete them temporarily right now, and so that you can see what I'm going to do. And you can see that with regression, we predict that utilities expense for administration department is going to be $143,000. But we've already decided that that regression-based number is pretty meaningless. So we're going to do something else. Instead of $143,796, what we're going to do is we're going to sum, equals the sum, of 2016's values. So we'll sum over to January. And then we're going to multiply this times 1 plus the consumer price index, which is 0.025. And so now we have summed this number together. We've got a new value. Actually comes up pretty close to what regression had predicted. But in this particular case, let's put some different coloring in now. And the colors that I used for this line item in the article were orange. Let's be consistent. So we'll home color, just get some little orange color going right there. And so this is our predicted value now. I'm going to once again go into our review and comment. This amount is based upon 2017 values inflated for the consumer price index. And there we go. So now I have, let's show that comment so we can see it right there. And I'm also going to highlight this row, and I'll make that orange as well. And then I'll complete that, that row. And actually, what I didn't really need to erase that row at all, because we're going to make this seasonal. So I can just take this row above, which has our seasonality formulas in it. I'll copy it downward, and then I'll have to repaint my data as orange. And so now what we have done is we've used a different method to predict row 191, utilities expense for the administration department. We use that based on a historical value inflated by the consumer price index. And then we simply seasonalize that data so that to the extent that 2017 had utilities expense that fluctuated, now our 2018 budget has similar seasonality reflected as well. We would repeat this process for every single value which does not meet the Pearson score. And this data, again, is sample data that we got from the Dynamics GP accounting system, and who knows where they got it from. But it's possible that this is actual company data, but it might just be fabricated data. And so having a bunch of these line items not obey the Pearson probably is not surprising, considering this is fictitious data. Your actual data may actually have a better trend to it than some of these line items in this Dynamics GP data. But for our purposes, we're fine, because I wanted you to know that some of your line items cannot be predicted or projected using regression, and here's an alternative method for that. So we're good now. In the article, the next step was to forecast the balance sheet. Now this is a more complicated process, so stick with me on it. I'm going to show it to you, but it can be done. Some CPAs would stop right here. They'd say, I'm done. I've now got my income statement based on regression. I seasonalized it. I replaced all the regression numbers with contract values where I was able to do that. I replaced all of the projections where the Pearson score was unacceptable, and in that case, I've done the best I can. And they would stop and say, I have my budget. But I would tell you that your budget is incomplete if it does not also include a cash flow forecast. And to produce a cash flow forecast, you have to forecast your balance sheet. And that seems like a daunting task, and yes, yeah, it is. But let me fast forward. I've already got a little bit of the skeleton of this thrown in so you can see it. So below my income statement, which is here, rows 280 and above, is my income statement. I have put in my balance sheet, my ending balance sheet for last year, 2017. For last year, I put that in here. The next thing that I'm going to do is talk about each line item. Property and equipment, which last year was $4.8 million, is going to remain $4.8 million because our company has not purchased any new property and equipment and doesn't plan to do so in the coming year. So this is an easy line item to predict, as is furniture and fixtures. Furniture and fixtures was $926,000 at the end of last year, and we haven't bought any new furniture and fixtures, and we don't have any plans to do so, so we can just predict this value as remaining the same throughout the year. And then we have accumulated depreciation, which comes right from our depreciation schedule. So this is pretty easy too. We all have a depreciation schedule. We can just take the numbers and we'll see the amount incrementing a little bit each month as we take more amounts of depreciation. But the harder amounts to predict are these. I left these in there, and this is what I focus on. Accounts receivable, inventory, accounts payable, those are the hard line items to project. And then long-term debt is actually fairly easy because that comes from an amortization schedule. But I'm going to work on these for you and try to give you a suggestion. Now, in order for you to project your accounts receivable or inventory or payables, you need to calculate the days in receivables, inventory, and payables from your history. So you would go back to 2017's actual data, and you would divide your accounts receivable balance from your balance sheet into your sales amount, and then you would divide that by the appropriate number of days to figure out the number of days in your payables, and your receivables. And so we've calculated that we had 42 days in receivables when we did that. And looking at all of our data for the entirety of 2017, that looks fairly consistent. It looks like 42 days is a reliable number we can use. So to move forward, here's what we're going to do. We're going to calculate our sales from above equals the sum, and let's go up to our sales amount, which is right here. It starts right here on row 22, and it continues down with our trade discounts, our sales returns, etc. Now, notice that I am including in my sales not only the sales line items, but also the subtotals. Okay, now here's a little CPA trick that probably a lot of you know, but I'm going to divide that number then by 2. So I'll sum those numbers, including the subtotals, so I've doubled up, divided by 2, and that gives me my total net sales, $737,550. Then I'm going to divide that number by 365 days and multiply it times 42 days. And that gives me my projected accounts receivable amount, 42 days worth of sales. It's the exact opposite formula we use to calculate days in receivables. Then I'm going to put in a -2 at the end, and at the beginning I'll put an equal round, and that rounds it, and I'll format that with no decimals, and I'll drag that across. And now I've predicted my receivables for the next 12 months based on my seasonalized income statement. We do the same thing for inventory, 62 days for the inventory. So I'm going to take my cost of goods sold amount, which is this amount right here, 288,600. I'll just take that subtotal and I'll divide that by 365, multiply it times 62. Is that what we said? And there is our inventory amount. Again, I'll format that. -2 round. We'll format it with no decimals. And then I'll drag that across. And I've predicted my inventory based upon the cost of goods sold values from above. To the extent that those cost of goods values are seasonalized, our inventory will be seasonalized. And it looks like the numbers from above don't have much seasonality to it because our inventory in this example doesn't change much. Now, accounts payable is a little harder. And the reason accounts payable is harder is because you've got to pluck out all of the numbers paid on account. And that's a harder thing to do. And so I'll do a little bit of it for you. I won't get it exactly right, but I'll give you enough to give you the idea. And so we're going to start by equal the sum, and we're going to sum all of our amounts that are expenses. In this case, we'll start with just below cost of goods sold. Variances aren't paid on account. Overhead and wages aren't paid on account. I don't even know what CPP expense is. I don't think those are paid on account either. Let's just start right here with life insurance. And I'll divide this by 2. So now we've got our total expenses. But now we need to subtract out those items that are not paid on account because we don't want those items to be included in this calculation. So I'm going to edit the account and type in a minus. And what I did was I've got a little purple, you can't even hardly see it, but I've put a little designator to me which ones I want to subtract out. Transfer suspense, I want to subtract that out. Minus, I'm going to scroll up. So I've cheated by going ahead earlier. And you see these, there's a little purple line right there. I'm going to sum these, minus the sum of these line items, which are miscellaneous expense, company meetings, warranty expense, project expenses, project losses, which I don't think we get a bill in the mail for, so they're not paid on account. I'll screw up a little more, and here are a couple other items, so minus the sum of these, I guess, 2 items, bad debts and write-offs. Minus, I'll screw up a little more, and there's some items right there that I meant to sum, minus the sum of those items. And minus the sum of just a few more right here. Those items too. And there we go. So now we come up with our net expenses that are paid off of bills. Bills come in the mail. They sit there till we pay them. Probably I would need to subtract out more numbers. But for this purposes of this video, I'll just stop right there. You get the idea. It's not an easy task. You've got to be very familiar with your data, and you'll go out and have to pluck that data out and get your number. Now I'm going to divide the whole product by, let's just put parentheses around the whole thing. And I'm going to divide by 365 days. I'm going to multiply times 28 days, and that becomes our amount. Why did it give me that error? I'm going to undo that because I don't know what happened there. Undo, undo. I meant to divide everything. I wasn't paying close attention. Equals. That should be okay. Divided by 365 times 28. And there we go. And then I'm going to round it, minus 2. Home key and equal round. And there we go. So now we have our accounts payable, and I'll take that amount and I will project that out. And our payable amount, which is a difficult calculation, and there's more to it than what I showed. Now we have long-term debt, and I have an amortization schedule here. I've already made this easier. This is the balance of our long-term debt right here that we need to transfer over to our budget. And to make it easier, I've used a little index formula. And the index formula basically takes 164, 812 and puts it here. And then 163, 997, etc., and 1615. And so I've just distributed the data horizontally. That just makes it a little bit easier. So now I come back to our balance sheet and type in equals round. We'll go to the amortization schedule and click that number, minus 2, and then we can copy that across. So now what we've done is we have put in our long-term debt as well. The next thing we need to do is calculate the change in each one of those items. So our change in accounts receivable is this amount minus the 2018 amount, or we'll have to do it again, equals the accounts receivable for January minus the accounts receivable for February. Those numbers don't look like they've changed much at all, do they? Well, I guess overall there was seasonality in that first row, but there wasn't much seasonality in all of the revenue numbers, so that's probably why. Then I'm going to copy this down. That'll work. And then for accounts payable equals our AP amount from last year minus our AP amount. And I almost made an error there, and that this should be a negative number. So I'll multiply this times -1, and I'll copy this across. We've got to keep our pluses and minuses correct. Okay, and we've done that now. And we'll take our accounts payable amount equals from last year minus this year. We'll do it again, equals January minus this year. And now what we'll do is we'll copy that downward as well. We can then copy this across. And now we show our changes. There's not much changes there. I wonder if I have some kind of error in there. That looks like there should be more changes. But we'll move forward. Our ending cash, let me show you that, was $234,600. That becomes our beginning cash the next month. And then our ending cash is going to be our beginning cash plus our income. So because our income is reversed, remember I said this in the article that Great Plains uses negative amounts for credits and positive amounts for debits, which is a little weird. But in our case, we want to subtract the income. So that's actually a loss of $77,000. And then we want to add to that amount the change in inventory. I've got a real serious problem right there. That's not going to be right, but that's okay. We can write our formulas and change that. Okay, let's put that long-term debt. Why is that such a big amount? And that's because I did multiply this times -1. You probably saw the error right away. I didn't see it. but I can correct it. I can find my errors and correct it. And there we go. And so next month, 143 becomes our cash for the following month. And we can copy that across. And then we can copy our ending cash calculations across. And then we can see our cash flow forecast for the coming year. And it looks like it actually climbs a lot in March, climbs a little bit in February, a lot in March, a little bit more, and actually becomes positive all the way through July. And then it dips down a little bit after July. August goes down, then it comes back up, goes down a little. And so we can see that basically we should have strong cash flow through July, and it gets a little bit weaker after the July timeframe. But it's a lot of effort to go through, but since cash is so important, it can be very worthwhile to take the extra effort to predict your cash. Now, the final amount, the final analysis for this is probably my most important point. I see people create budgets all the time and then ignore them all year. At the end of the year, they look at it and go, well, we missed our budget, didn't we? Whoa, that wasn't even close. Oh, what happened to us? So if you're going to create a budget, the eighth item, the eighth step, is to use the budget. That means you reference it throughout the year. Every time you make significant expense decisions, make sure you're making them in context of what your plans were, and if they're outside the scope of what you had predicted, consult management, get approvals, rethink your decisions and those types of things. Then during the year, you want to compare on a monthly basis at least your actual to budgeted items and look for any anomalies, anything that's out of whack, that more than, let's just say, 10% or $10,000, as I suggested in the article. And any item that is significantly out of whack, you investigate that. You look at it because it usually and probably is just a clerical error. Somebody entered the wrong account number for a line item. But it could be fraud. Somebody is stealing money, writing checks and putting them against that account, etc. And the money's going out and you didn't expect to pay 24 utility bills. You only expected to pay 12, but now you see double billing. Well, some sly person in the accounting department or some sly person outside your company is billing you for utilities you're not actually receiving, and your people didn't catch it. They just paid it. So you look for those. You give it scrutiny. You analyze the significant deviations in detail, and you come up with a reason that explains each one of them, and then you resolve it. And that's what the good CPA will do. And so if there is fraud, it can't last more than a month because that CPA will flush out that fraud and take the corrective measures to clamp it down so it won't happen again. We don't know who's doing it, but somebody's doing this. Well, we're going to take these measures to prevent that from happening, and we'll try to catch the perpetrator as well. But that's the most significant thing you want to do is have a budget and follow it so that you can stick to your plans and so that you can help prevent fraud from occurring in your organization. In the final analysis, budgets, they're not anybody's friend. They're tough. Nobody really looks forward to doing it. It's like a chore at the end of the year. But I've come to believe that the budgeting process is essential and actually can be your best friend if done right. So I hope this article helped you a little bit. Thank you very much for watching this video. Have a great day.